Hello everyone, welcome to EPK Capital's deep dive video. I am your host Kunal. In this series, we analyze and scrutinize one company each day based on its last 10 years financial data, its fundamentals, and its management. So, you can decide on whether the company is a sound investment or is overpriced. Today we are going to talk about Wipro. Just a quick note that this video is for educational purpose only and should not be taken as a financial advice. For your personal advice, you can connect with us or your personal financial advisor. Wipro. It's a name that's almost synonymous with the Indian IT revolution. A nifty 50 stalwart, a global tech giant, and for many, a symbol of long-term wealth creation. But if you've been watching the markets, you've probably noticed something. While its peers have often been in the fast lane, Wipro's stock has felt stuck. It's a company with a legendary past but an uncertain present. This raises the critical question for any investor. Is Wipro a sleeping giant on the verge of waking up? Or is it a classic value trap? In this deep dive analysis, we are going to dissect Wipro from every angle: its history, its financials, its valuation, and the controversies. Our goal is to give you a comprehensive, unbiased picture so you can understand the full story behind this IT titan. Here's what we'll cover. We'll start by understanding the company's incredible journey and the powerful promoters behind it. Then, we'll dive deep into a 10-year financial health check, looking at everything from revenue growth to debt. We'll analyze the stock chart to see what the technicals are telling us. For all the value investors out there, we'll run the numbers using Benjamin Graham's famous valuation formula. We'll then lay out the bull versus bear case in a clear pros and cons section. Crucially, we'll look at some important checks every investor must make, including corporate governance red flags. Finally, we'll tie it all together with a balanced conclusion. Let's get started. To understand Wipro today, one must appreciate its extraordinary history of transformation. The company's origins are unique among its tech peers. It was founded not in a garage in Silicon Valley, but in 1945 by Mohammed Hashim Premji as Western India Vegetable Products Limited, a manufacturer of vegetable ghee and refined oils. The first major pivot came in 1966. After the founder's untimely death, his 21-year-old son Azim Premji took the helm. Recognizing a massive opportunity in the 1980s as IBM exited the Indian market, Premji steered the company towards the nascent IT industry. This was a bold, visionary move that laid the foundation for the Wipro we know today. The company went through a series of key milestones, including its public listing and a landmark listing on the New York Stock Exchange in 2000, which cemented its global footprint. By 2004, it had crossed the significant milestone of $1 billion in annual revenue. Another critical strategic shift occurred in 2012 when Wipro demerged its non-IT businesses, including consumer care, lighting, and infrastructure engineering, into a separate private entity called Wipro Enterprises. This was a deliberate decision to sharpen its focus on the core, higher-margin IT services business. While this move aimed to streamline operations, it also removed the stable, cash-generating consumer goods business from the publicly listed entity. This separation may have inadvertently increased the company's exposure to the natural cyclicality of the IT services market, where client spending can be volatile, potentially contributing to some of the inconsistent growth seen in the following years. Today, Wipro is a global information technology, consulting and business process services (BPS) company. It operates on a massive scale, with a presence in over 66 countries and a workforce of more than 230,000 people. Its revenue comes from a wide array of IT services, which can be broadly categorized into application development and maintenance, building and managing the software applications that businesses run on, digital transformation and consulting, guiding companies in adopting new digital technologies to improve efficiency and customer experience, cloud and infrastructure services, managing clients' IT infrastructure, including data centers and cloud setups, cybersecurity, protecting clients from digital threats, data and analytics, helping businesses make sense of their data, a field where Wipro has shown considerable strength. The story of Wipro is inseparable from the legacy of Azim Premji, often called the Tsar of the Indian IT industry. His leadership over 4 decades transformed the company, and his influence remains profound. A defining characteristic of the Premji legacy is an immense commitment to philanthropy. Through the Azim Premji Foundation, he has dedicated a substantial portion of his wealth to improving public education in India. A majority of the promoter group's stake in Wipro is directed towards these philanthropic activities, adding a unique environmental, social, and governance (ESG) dimension to the company's profile. Today, the leadership has transitioned to the next generation, with Azim Premji's son, Rishad Premji, serving as the executive chairman and Srinivas Palya recently appointed as the CEO. This brings us to a crucial point for any investor: the shareholding structure. The promoter group, led by the Premji family, holds an exceptionally high stake of approximately 73%. This high holding ensures a long-term vision and stability, but it also creates a unique governance dynamic. It means that the collective vote of all public shareholders, from small retail investors to large global institutions, can be overruled by the promoter group. This power imbalance was brought into sharp focus during a recent controversial decision, which we will discuss later in our governance check. Now, let's move from the story to the numbers. A look at the last decade of financial performance reveals a company with clear strengths and persistent challenges. Revenue and profit growth, the story of a laggard. Looking at the 10-year trend, Wipro's growth has been inconsistent. While there were periods of solid performance, recent years have been marked by stagnation. The company's revenue growth has lagged behind the industry average. Over the last 5 years, its revenue grew at a yearly rate of 7.79% compared to the industry average of 10.98%. More recently, revenue has even seen a year-over-year decline. This underperformance relative to its peers is a central part of the investment debate surrounding Wipro. A company's profitability margins tell us how efficiently it converts revenue into profit. Wipro's operating profit margin, OPM, has historically been healthy, though it has seen some compression from its peak in FY21. 16. The OPM tells us how much profit the company makes from its core business operations before interest and taxes. A stable or rising OPM is a sign of a healthy, efficient company. The recent pressure on margins can be attributed to factors like industry-wide wage inflation and increased competition, which affects pricing power. This is where Wipro truly shines. The company boasts a fortress-like balance sheet. Its debt-to-equity ratio has remained consistently low, currently around 0.2, which indicates a very conservative approach to leverage. In fact, the company often holds more cash and cash equivalents than its total debt, giving it a strong safety net and significant financial flexibility for potential acquisitions or robust shareholder returns. This financial profile is less like a high-growth startup and more like a mature conservative blue chip. The combination of slower revenue growth with a powerful balance sheet and consistent dividend payouts suggests a management strategy that may prioritize stability and capital return over aggressive debt-fueled growth. Return on equity, or ROE, measures how much profit a company generates with the money shareholders have invested. A figure consistently above 15% is generally considered good. Wipro's ROE has been respectable, recently hovering around 16 to 17%. However, this is a step down from the levels above 22% seen in FY21 and FY22, indicating a recent dip in capital efficiency. Fundamentals tell us about the company's health, but technical analysis tells us about market sentiment and price trends. Looking at a long-term price chart of Wipro, a clear story emerges. The stock experienced a massive rally during the IT boom of 2021, hitting an all-time high. However, what followed was a significant correction and a prolonged period of consolidation and downtrend. While the 5-year return is still positive at around 74%, the 1-year return has been flat to negative, highlighting the recent underperformance. This price action perfectly mirrors the fundamental story. The euphoric rise in 2020-21 was a sector-wide phenomenon, but Wipro's subsequent failure to reclaim those highs, unlike some of its peers, shows that the market is pricing in company-specific challenges, such as its slower growth and execution issues. The chart is a visual verdict on the fundamental narrative. In his book, The Intelligent Investor, Graham proposed a formula to estimate the intrinsic value of a growth stock. It's important to note that Graham himself warned against using this formula mechanistically, but it provides a useful, quick valuation estimate. According to this specific Benjamin Graham formula, the intrinsic value of Wipro is approximately R132 per share. Comparing this to the current market price of around R247.22, the stock appears to be significantly overvalued. This calculation highlights a key value investing principle. Even for a company with a lower PE ratio than its peers, if the future growth prospects are muted, it may not be cheap in an absolute sense. It also underscores Graham's caution. The growth rate, G, is an assumption, and a higher assumed growth rate would yield a higher intrinsic value. Every investment has two sides. Let's break down the arguments for and against investing in Wipro. The bull case, reasons for optimism. Relative valuation. Wipro trades at a PE ratio of around, which is a noticeable discount compared to peers like TCS, which trades closer to 25. This suggests it could be relatively undervalued. Strong financial health. The company's balance sheet is a major source of strength. It is virtually debt-free and has a strong cash position, providing a high degree of safety and stability. Consistent shareholder payouts. Wipro has a reliable track record of returning cash to shareholders through dividends and buybacks, making it attractive for income-focused investors. Turnaround potential. A new CEO is at the helm, and the company is focusing on high-growth areas like artificial intelligence, cloud, and consulting. Recent strong deal wins, particularly in data and analytics, show signs of promise and could reignite growth. Stable promoter backing. The high promoter ownership ensures a long-term vision and commitment to the company's stability. The bear case, reasons for caution. Persistent underperformance. The most significant red flag is the company's consistent history of lagging its peers in both revenue and profit growth. Past performance is not indicative of future results, but a long-term trend of underperformance is difficult to ignore. Execution risk. A turnaround story is compelling, but its success is not guaranteed. The company has faced execution challenges in the past, and there are risks associated with integrating large acquisitions and implementing new strategies. Margin pressure. While margins are currently stable, they have declined from their recent peaks. The IT industry faces persistent headwinds from wage inflation and intense competition, which could put further pressure on profitability. Corporate governance concerns. Recent events, which we will detail next, have raised questions among investors about board oversight, transparency, and the treatment of minority shareholders. Lukewarm analyst outlook. Future growth forecasts from analysts are modest, and the consensus rating is largely hold or neutral. This suggests a lack of strong conviction from the expert community about a near-term recovery. Before making any decision, there are a few final checks every investor should perform. Shareholding pattern, deep dive. As mentioned, the promoter group holds about 73% of the company. Foreign institutional investors, FIIs, hold around 8.2%, and domestic institutional investors, DIIs, including mutual funds, hold about 7.5%. The high promoter stake results in a relatively low free float, the percentage of shares available for public trading. This can sometimes lead to higher price volatility. Corporate governance scan, the red flags. Corporate governance is a critical, often overlooked aspect of investment analysis. Two recent incidents at Wipro are noteworthy. The CEO severance controversy. In 2024, Wipro's board approved a cash severance package of over Rs36 crore, 4.33 million, for its outgoing CEO, Thierry Delaporte. This decision faced massive opposition from public shareholders, with 78.4% voting against it. Despite this, the resolution passed because the promoter group's 73% stake voted in favor, effectively nullifying the concerns of minority investors. This event is a stark illustration of the power imbalance in the company's shareholding structure. 2. The defamation case. The Delhi High Court recently fined Wipro for character assassination of a former employee. The court found that the company had included unsubstantiated and damaging remarks in the employee's termination letter, harming his professional reputation. This incident, while smaller in financial scale, raises questions about company culture and potential legal risks. The combination of modest growth forecasts and these governance issues creates a significant headwind for investor sentiment. A stock's price depends not just on its earnings, but also on the valuation multiple the market is willing to pay. Governance concerns can suppress this multiple, meaning that even if Wipro achieves its growth targets, the stock price may remain capped until it demonstrates both improved performance and a stronger commitment to minority shareholder interests. So, what is the final verdict on Wipro? On one hand, you have a company with a storied legacy, a rock-solid balance sheet with almost no debt, and a valuation that looks attractive next to its high-flying peers. It's a consistent dividend payer backed by a stable, long-term promoter. On the other hand, this is a company that has struggled for years with inconsistent growth, lagging the very peers it's valued against. Its turnaround story is still a work in progress, carrying significant execution risk, and recent corporate governance issues have raised valid questions for minority shareholders. Ultimately, the decision to invest in Wipro comes down to your investment philosophy. If you are a deep value, patient investor who believes in the long-term turnaround and values balance sheet safety above all, Wipro might look compelling. However, if you are a growth-oriented investor looking for market-beating performance and flawless execution, the data suggests there may be better opportunities elsewhere in the IT sector. Is Wipro a value stock or a value trap? The answer will likely be written in its performance over the next few years. For now, it remains one of the most debated giants of the Indian stock market. Disclaimer: this video is for educational and informational purposes only. The presenter is not a SEBI-registered financial advisor. The content of this video is not intended to be investment advice. Please conduct your own research and consult with a qualified financial advisor before making any investment decisions. Investing in the stock market involves risk, including the loss of principal. We hope this video was informative. If you think it did, then please do like and share the video. Also, do subscribe to our channel for such wonderful daily content. For more information or for your personal financial advice, kindly connect with us on the details given in description. I will see you in the next video. Thanks for watching.